X100%. Engineer your financial freedom.
Hey there, if you've spent any time at all looking into the world of investing, you have absolutely heard the term ETF. I mean, they are everywhere. They've gone from being this kind of niche product to a massive multi-trillion-dollar industry, and they've totally changed the game for how millions of people build wealth. But what in the world are they, really? And more importantly, why should you care? Well, in this explainer, we're going to pull back the curtain and demystify the exchange-traded fund once and for all. So here's our roadmap. First, we'll talk about the ETF revolution, to get a handle on why there's so much buzz. Then, we're going to pop the hood and see how these things actually work. After that, we'll dive into their biggest advantages, explore the incredible variety of ETFs you can find. And finally, and this is super important, we'll cover the risks you absolutely need to watch out for. All right, so Section 1, the ETF revolution. Why is everybody talking about these things? Well, the short answer is that ETFs managed to do something pretty brilliant. They took the best part of a mutual fund, which is diversification, and smashed it together with the best part of a stock, which is the ease and flexibility of trading. That simple but really powerful combination created an investment tool that's incredibly accessible and efficient. It's no wonder they've become a total cornerstone in millions of portfolios. Okay, so that leads us right to the main event, the big question we're here to answer. It sounds complicated, right? Exchange-traded fund, but I promise you the core idea behind it is actually wonderfully simple. It's quite elegant, really. So let's break down what it actually means. Okay, let's really unpack this definition because it's the key to everything. An ETF is first and foremost a fund. That means it holds a whole collection of different things. Assets like stocks, bonds, you name it. But here's the magic part. It's exchange-traded. That means you can buy it and sell it on a stock exchange all day long, just like you would a single share of, say, Tesla or Microsoft. The grocery basket analogy is perfect. Imagine instead of going down the aisles and picking out 500 different items one by one, you could just grab a pre-packaged basket that has everything you need in one go. That's an S&P 500 ETF. With one click, you own a tiny piece of all 500 companies in that index. It's instant diversification. Now, this is where it gets really cool. The real genius of an ETF, the thing that makes it so efficient, is how it's all put together and managed behind the scenes. It's not just a static shopping list of stocks. It's actually this dynamic system that's designed to stay perfectly balanced and easy to trade. And the secret sauce, the gears of this whole engine, is a mechanism called creation and redemption. Now, this sounds a little technical, but stick with me. It's run by these big financial institutions called authorized participants, or APs, and their entire job is to act like market mechanics, constantly adjusting the supply of ETF shares out there to make sure the ETF's price stays almost perfectly in line with the actual real-time value of all the stocks and bonds inside of it. So let's walk through exactly how this works. Imagine a lot of people suddenly want to buy a popular ETF. Demand is high. So an authorized participant, that AP, jumps into action. Step 1. They go out and buy up all the actual stocks that the ETF is supposed to hold. They create that basket of groceries. Step 2. They take that whole basket of stocks and hand it over to the ETF company, like Vanguard or BlackRock. In return, the ETF company gives them a big block of brand new ETF shares. Step 3. The AP then takes those new shares and sells them on the open stock market to all the investors who want them. Now, Step 4, redemption, is just that whole process in reverse. If tons of people are selling the ETF, the AP buys back those shares and trades them back to the ETF company for the underlying stocks. This constant push and pull, this creation and redemption, is the genius that keeps the whole system balanced and fair for everyone. So now that we've seen the mechanics, let's get to the good part. What's the actual payoff? Why have millions of investors been flocking to ETFs instead of other things, like those traditional mutual funds? Well, the answer is this really powerful mix of benefits that solve some of the biggest headaches in investing. Let's put ETFs head-to-head with their older cousin, the mutual fund. This is where you really see the difference. First up, trading. With an ETF, you can buy and sell it any second the market is open. Its price changes constantly. A mutual fund? Nope. You place your order, and it only gets filled at one single price at the very end of the day. Second, and this is a big one, cost. Because most ETFs just passively track an index, they don't need expensive managers, so their fees, or expense ratios, are generally way, way lower. And finally, transparency. With an ETF, the fund has to tell you exactly what it owns every single day. You know what you're getting. With most mutual funds, they only have to disclose their holdings maybe 4 times a year. It's a huge difference. And the list of benefits keeps going. 2 other huge ones are tax efficiency and accessibility. Remember that creation and redemption process we talked about? Well, because of how it works, ETFs tend to spit out fewer taxable capital gains for you, the investor, to deal with at the end of the year. That's a huge plus. And then there's accessibility. You want to invest in emerging market stocks or gold or maybe the robotics industry. It used to be really hard or expensive to do that. Now, you can bet there's an ETF for it. And that accessibility has led to an absolute explosion in variety. The world of ETFs isn't just about tracking the big indexes like the S&P 500 anymore. Not at all. It has expanded to cover pretty much any investment strategy, any corner of the market, any asset class you can possibly think of. This table here gives you a really good snapshot of the main flavors. You've got your index ETFs. Those are the classics, the foundation. Then you have sector ETFs, which let you make a more focused bet if you're really optimistic about, say, technology or healthcare. Bond ETFs are a fantastic way to add some stability to your portfolio. Commodity ETFs let you invest in things like gold without having to actually, buy and store gold bars. And thematic ETFs are really fascinating. They let you invest in big, forward-looking ideas like artificial intelligence or clean energy. And just look at this number to get a sense of the scale. Over 2,000 ETFs. And that's just in the United States. This incredible amount of choice is awesome, for sure. But it also means you really have to do your homework to make sure you're picking the fund that actually aligns with what you're trying to achieve. Okay, but of course, no investment is a free lunch, and it is absolutely crucial to have a balanced perspective. ETFs offer some incredible benefits, there's no doubt about it. But there are also potential downsides and costs that every single investor needs to understand before they dive in. So let's talk about them. First, trading costs. Even if you're not paying a commission, there's something called the bid-ask spread. Think of it as a tiny built-in transaction fee on every trade you make. For the really popular ETFs, it's tiny, but for less traded ones, it can be bigger. Then there's tracking error. That just means the fund might not perfectly, 100%, mirror the index it's trying to follow. But honestly, perhaps the biggest risk is a psychological one. Because ETFs are so darn easy to trade, it can be really tempting to overtrade, to buy and sell based on headlines and emotions. And that can be disastrous for your long-term returns. This quote really just sums it all up perfectly. The rise of the ETF isn't just some passing fad. It's a deep structural shift in how investing works. They've effectively democratized strategies that not too long ago were only available to the super wealthy or big institutions. They've leveled the playing field for all of us. And that's really the key takeaway from our explainer today. When you understand how they work, when you appreciate their incredible advantages in cost, transparency, and flexibility, and when you're aware of the potential risks to watch out for, you can use ETFs as a powerful tool to build a sophisticated, diversified, and low-cost portfolio that's tailored exactly to your own financial journey. And that brings us to our final thought for the day, a question I want to leave you with. As you think about your own future, your own goals, just ask yourself this. How could using a strategy built on broad diversification and super low costs help you get closer to where you really want to be? It's a powerful question, and for a lot of people these days, a big part of the answer lies in a tool just like the ETF. Thanks so much for joining me.